Well, first of all, let's define what the efficient market hypothesis is. And generally speaking, it's a financial theory that states that whatever the price of the traded security is right now, it's reflective of all the public information about that security. So it's an efficient price that reflects all public information, and there's really no way to make outsized investment returns unless you have some insider trading information.
I guess a simple statement would be there's really no obstacles to the flow of capital or information.
Whatever public information that's out there in the marketplace is reflected in the pricing of securities. So there isn't really a way to make outsized returns unless you have insider information.
Basically, the degree of information disclosure in China is very low. Like they don't, all the stuff that normally comes out in like on New York, everything becomes immediately public. But in China, they withhold information. They don't give all the information, so the average investor doesn't have the full amount of information to really make effective decisions. Exchange is based on the weighted average market prices of all the stocks that are listed on the exchange, but then 70 to 80% of those are not allowed to be on that exchange. So that sort of skews the whole, it's like a potential market versus the actual real market.
There are two different classes of shares. There's an A share class and there's a B share class. In 2000, I believe it was 2002, the regulations were loosened so that foreign investors, institutional investors, could now actually invest and buy into the A share class.
Well, I mean, definitely there's the laws that go around the regulation, like the penalty for even lying or falsifying information is really not that strict, and it's only about $5,000 if you're caught lying. So there's a lot of there's really no incentive for people not to try to lie to make extra money.
Well, for the most part, I think that 99.5% are retail kind of smallish investors, people who own account values of less than $5 million. And then I believe 0.5% of the number of investors are institutional. So really, it's a very retail-driven marketplace. And because of that, and actually in addition to that, they're very unsophisticated. And it's a relatively young market. I mean, it's pretty much 30 years old. So the people there in China there isn't really a long history of people with an experience trading and investing in the market, and having experience being an institutional investor. So it's like an unprofessional type of environment. So people get caught up in the booms and the busts, and there's just hyper volatility. Yeah. So this is the graph, right? Yeah. So right here is where we had, for the most part, it seems like prices are just kind of stable. Mm-hmm. And then you have these huge periods of parabolic price appreciation. And then after that, they're just followed by complete busts where the price crashes. And usually at these points when the price crashed, the Chinese government steps in and they start banning the sale of shares. They ban short selling. They'll mandate state-owned enterprises to actually go into the marketplace and buy equities to try and put to stabilize the prices. So they'll do a lot of intervention into the marketplace. About a couple of years ago in 2015, right here you can see the market spiked up a lot. I think it was up 40-50% or something. And then the next year, the market crashed 40-50%. So in that crash is one of the times that China actually came in and intervened.
And another thing they do too is with the penalties, if the stock market's not doing very well, they impose less penalties even. So they kind of regulate based on the fluctuation of the market. So the regulations are even changing based on their view of the market.
I think one of the deterrents to actually having efficient prices in Shanghai, or a barrier to that, is the transaction costs. So in Shanghai, it's about 1.5% to buy and sell. So if you see some mispricing based on some information that you may not want to take advantage of that mispricing because of the transaction costs. So I think that is one of the factors that makes it less efficient.
Yeah, and like Adam's point, that's like, just put it in our terms, it's 3 to 4 times more costly for them than it would be for us.
So in terms of the efficient market hypothesis, number one is the fact that transaction costs are really high. So 1.5% to buy and sell. So if you are a market participant and you knew some information that you could trade on, you may not necessarily want to do that because the transaction costs are so high. Second point is that the degree of information is low. So you may have some regulatory financial intermediaries that do accounting. You may not necessarily trust what they have to say. And then number two, the penalties on that is really low, $5,000. So there really isn't, there isn't really a deterrent to make sure that everybody is playing by the rules. Thirdly, the market participants are all retail investors for the most part, very, very few institutional investors. And because of that, as an institutional investor, you're constantly out there and as your job, researching different companies, researching the market, gathering all this information, building your models, figuring out what the price should be, doing discounted cash flow, all that stuff, right? Interviewing management. But as a retail investor, you're not doing any of that. You're just speculating. It's like you're going to Vegas and you're buying and selling and you're just gambling. So when you look at the price of the Shanghai Stock Exchange and the index, you can see a chart pattern that's very, very volatile, and you get these huge parabolic spikes up and then huge crashes down. And generally the trend is up, but it's kind of like this, when all of a sudden it breaks out and then you just get this parabolic spike. So that's all based on this retail kind of psychology. And I don't know if I necessarily trust that the market prices are efficient because, as I said, they're not really doing any research. So that was third. Another reason is also the difference in the between the A shares and the B shares, right? So you have A shares, which are share classes that are mostly owned by Chinese nationals, and then the B shares are owned by more foreign companies. And to own there's been history of the A shares being overvalued relative to the same company and the same stock that's on the B share platform. So one of the reasons why that may be the case is because the A share market is kind of blocked to institutional investors. The institutional investors were allowed to gain access to the A share market in 2002 during a government program, but there's limited access. They can't buy as much or sell as much as they want. Plus, once they buy into it, there's a gate on when they can get out, and that's pretty much 20% of how much they own per month. So there's all these barriers, of free flow of capital is another reason, where the barriers of going in and out and making sure that the prices are as efficient as possible.
Think about it, it's a new country. They just opened up to the world in 1990, and this whole thing has grown immensely, right? But I think that when you look into the future, over 15 years, I think that how it exists back then or maybe now isn't going to be the way that it operates in the future.
We also talked about like the China, they really want to control, and so all their stuff that's state owned, it's hard for them to let it just go into the free market, because then their companies are not in their control anymore. So I think that's something that they'll be struggling with, of which how can you have a true free market then if they really want to be in control of a lot of the stuff. So yeah. I think that's going to be their challenge.